Hello, everybody. Sorry for the delay. We had technical problems with the sound. And so, of course, at the beginning of every show, we like to talk about, kind of a summary of what we saw happening with the market. And really appreciate your patience here. Just starting off on this summary, so I'll start off with this. And of course, we've been looking at this chart of the S&P 500 for a couple of years now, actually. And you can see this goes back to really 2021. We had that great run up. We hit the high at the very beginning of 2022, dropped 28%, got to October of 2022, and then we had a really nice recovery, and especially right at the end of the year, one of the really historic climbs that came out of that downturn from the end of October till really the end of the year. So this week, what we're seeing, of course, is some downturn. This is not unusual, especially in a year where you have a lot of gains. And if you look at what is selling off, it is mostly the things that have big gains from last year, right? So that makes sense. You don't want to take those gains in December, really. If you had a stock that you think you want to pare back on or what have you, take some profits, or maybe you want to sell something and buy something else that has that whatever you're selling has a profit. You normally would want to do that in January. Because it just allows you to, have the rest of the year to maybe if you have some losses, you can write off against them. You do it in December, you're going to have to pay that, maybe in April or even January 15th with your quarterly payments, depending on how you do it. So not unusual after a year like this to see this type of scenario, at least in the first week or two, some weakness as far as that goes. We're actually deploying some of our excess cash today. We had that downturn, little backup. One of the things you'll notice here, it's a little bit faint, but there's a line that goes across that shows kind of where we are today. If you look back really at the end of 2021, you can see we're right at a resistance level. We're sitting right at a spot that has some support. So not a bad place to be nibbling, in my opinion. There's a lot of things that are going on that I think are pretty good as far as that goes. And we'll talk about, some of the things that came out even today as far as that goes. But really amazing chart. It's a lot of volatility.
Yep.
I mean, if you look, there's a lot of ups and downs there. Just because, again, when you raise rates as much as we've raised rates since the really beginning of 2022, that should be down pretty substantially. It should be coming down more smoothly, kind of like what we saw in 2008. But because we have these other counter forces, the pandemic, the government put out a lot of money, and people are having more fun now, going out and doing things and spending money. The consumers out there doing pretty well, traveling and what have you too. So that really is kind of these two forces that have been battling back and forth. And really overall, the good side is one. That's kind of why we're back. We almost hit an all-time new high again at the very end of the year. We backed off of that. I don't think backing off is a bad thing.
Yeah, it gives room to grow, kind of take a break.
Yeah. Well, we'll talk about this in a minute too. It's kind of stretched out, so it needs to come back. But it's almost like it's on sale. I mean, we always hear this. Hey, I got it on sale. And it makes you spend money. But if you liked it at a certain price, and if it's cheaper, and some people maybe missed out on some of this run up as far as that goes. And so you get this kind of spot where it moves. And the other thing I always talk about, if you look at that downturn that happened kind of right between Easton and I, that ended in October 27th.
Yep.
Well, mutual funds have to capture their losses by the end of October. And so lots of selling happens, right? But then what happens? You now have cash. And so then money starts to come back in. And there's a whole host of factors that would cause that type of run up, with short covering and the Fed, cutting back on, their rhetoric about raising rates and all these things, and inflation doing better, et cetera. But the same thing's happening now. Yeah. If a lot of people are taking profits and they have cash, I saw a stat today that $57 billion this week was put into money markets. And so that's a lot. And so that's enough money to maybe get the thing going again. So that's why we're kind of nibbling here also as far as that goes. If we look at kind of this measure here, okay, I just added this purple strip in here. This is called the RSI. It's a relative strength index. It's developed by a gentleman by the name of Wilder. It is very well followed. Matter of fact, you can tell kind of what's going to happen based on this. I always talk about the stretch of the rubber band, because that, to me, it just kind of makes sense. you take a rubber band and you stretch it, you can get certain distance, but the farther you go, the more resistance you get, right? And eventually it kind of snaps back down, and because the resistance gets just so high. If you look at what happened here, that peak right above Eason's head there, that was a 82.
Yeah, that's
Yeah,
quite high.
that's very high. Matter of fact, that's the highest in this going back to 2021 here. It's the highest it's been, and so that's a pretty extreme stretch. I've seen 86, way back. I've seen some higher ones, but what's going to happen there is you're bound to have some type of pullback off of that stretch. And again, now we're back down. It's hard to see these numbers, but we're back down to 55. That's quite reasonable, getting kind of into that average arena as far as that goes. So that's part of that kind of taking a rest also, is kind of get back down. It'll allow people that look at these types of things more confidence to come in with their money. One of the reasons we had some excess cash, because I hate buying when this thing is above 70.
Yeah.
Because we always have money coming in from all kinds of different sources, and we'll usually hold off when this thing gets above 70 just because it generally comes down after that. Matter of fact, Eason found a really cool chart here. A little hard to see all these numbers, but if you just look at the bottom here, the grayed out portion, the average. So if you look at when it gets above 70, right, on a 1 month basis, 1 month later, it is negative on average, negative 1.14%, and it's only positive 47% of the time. So again, if you're buying when this thing is above 70, at least in the very short term, you might be looking at some loss, for the 1 month basis. When you get out to 3 months, positive, not a lot, but positive, 6 months, 12 months. 12 months is actually very fascinating. 12.07 is higher than the average. Average is around 11.
Yeah.
A little bit less, but around 11 long term. And this again for the S&P 500, but 94.7% positive. Of all of these times where it got above, going back to 1990, right? That's pretty good. And so what that means to me is that sometimes when you get these big stretches to the upside, there's a lot of excitement,
Yeah.
right? And that excitement doesn't dissipate immediately. And it's a lot of these indicators are the breadth, the Martin-Zweig breadth thrust indicator is kind of the same thing. Huge motion upward. It just, again, it's only happened 18 times since 1945. But what it shows is just this excitement that's there, and it doesn't disappear immediately. And so, even though we might have some downturns and what have you, right now I think it's some profit taking and whatnot. Altogether, that's a good thing. It brought us back down to RSI. It's around 55. That's better, and I think we can kind of keep going forward from here. Now, I wouldn't be surprised to see some of that profit taking continuing again for another week or so.
Yeah.
And there are some important points here. Let me go back just real quick. We almost got to the all-time high. All right. In technical analysis, when we look at this, what that means is so far what we have is a double top.
Which is not a good sign.
Not a good thing. Now I think we're going to break through and we'll set it up, but it is important going forward here to watch for that and make sure that we do break through. And then I'll feel much more, comfortable about that, because the double top is one of these things where, looking back historically, you can then, you could literally be in a range here, a very big range, where you're kind of going sideways, and so you fall back down towards that bottom, those types of things. I think there's enough power for what's happening out there right now to keep this going and keep this moving forward. There's certainly enough money on the sidelines to kind of do so. But I wouldn't be surprised to see a little bit of weakness here again for another couple of weeks. Now, this is very fascinating. Easton also found this chart. What this shows is going back to 2014. You can see, the average rate of return for the total rate of return for the S&P 500 and how much the top 10 contributed to that. So if you look at 2023, return was 24%. That light blue, the darker blue is 17%. So it means that of that total percentage, 24% gain, 17% came from the top 10 stocks of the S&P 500, and the little green bubble up there says 75% of the return, right?
Yeah.
That's pretty high. Right?
Yeah, it's pretty unusual for a year.
It is. Now, here's something, and so here's something that I think is important. What's been talked about, this market's so narrow, it's not going to hold up. Right? Because it's so narrow, it's going to fall apart and what have you. I actually disagree with that. In my experience long term, going past the data, this chart, when things are uncertain, All right, and there's no doubt there's a lot of uncertainty here. You had most of Wall Street predicting a recession for last year. I mean, an
Hmm.
unbelievable number. Matter of fact, I saw projections for negative 20% last year all over the place. So if you're a big money manager, you don't want to abandon all of your stocks. But you're going to move money towards some of these big stocks. Matter of fact, I don't know if you guys remember this, but their debt ceiling argument that we had,
Hmm.
we started seeing those stocks do well.
Yep.
Because the thought process was, hey, Apple, Microsoft probably survives this debt ceiling debacle better than some. And so during times of uncertainty, they tend to buy these really big companies. And the reason that they're big is because they're well run and they usually have really good financials, and they have lots of cash flow, maybe even lots of cash on hand. I mean,
Hmm.
hundreds of billions of cash on hand sometimes. And so what will happen though, if the market continues to do well, is you'll see a broadening of that out. So a lot of people are pointing to it and say, oh, the market's going to fall apart because it's narrow. I'm actually saying, hey, this is the beginning of an upturn. Potentially, and it's not that unusual to have this happen in times of uncertainty. And so, right at the end of the year, we started seeing small cap stocks do well.
Yeah, they're
Matter,
still running.
matter of fact, we've kind of accumulated some of those ourselves here in our portfolio. And again, that's going to be the evidence of that kind of broadening, is seeing that mid cap, small cap kind of take off, the other 490 stocks in this index starting to do well. There's always something not doing well, even in great markets,
Hmm.
and there's always something doing spectacularly well. But this is not unusual to see in a start of a run, right? So let's not, get too carried away with it's too narrow. It could be okay. It will be important to see some breadth come through, get through to that new all-time high with some more breadth. That's what I'm looking for. And so we're waiting for that. That'll be something to watch for in 2024. The job report came out today. So this is in Bloomberg. It just shows how many jobs were created, right? Month by month since October of 2022. That was the low point for the stock market.
Yeah, it was pretty good with jobs report. It came
It,
in slightly, I think, above expectations.
yeah, I copied the chart out of Bloomberg here, and so kind of fascinating. So expectation was 175,000. We created 216,000 jobs. I keep getting asked, why is the stock market doing so well if the economy is not doing well?
Hmm.
And my answer is really simple. Number one is the stock market is a leading indicator. So it is predicting what's going to happen. And the reason that it came up from October of last year to now is because the economy is actually quite good. If you look at job growth, it's been fantastic. Now, jobs are not the best thing to look at because
Hmm.
they tend to lag the actual economy, mainly because, it takes so much time to hire and get the ads out and interview people. And it also takes a lot of time to let people go,
Yeah.
right? You got to go through the process, figure it out. So jobs can be kind of a lagging, but these are actually really good numbers.
Hmm.
And unemployment was 3.7, estimate was 3.8. That's a good thing. And then average hourly earnings were up 0.4%. Again, if you annualize that out, that's 4.8%.
Yeah, and having a strong economy, there's some fears that Fed will keep the rates the same and
Yeah.
not lower them. So that's one fear in the
Well,
market.
this is the biggest irony. So if you're worried about a recession, this is a good report
Hmm.
because it's less likely, especially with the earnings growth and what have you, to give some people some chance to spend money and keep a recession at bay. If you're worried about inflation, this report makes you a little bit nervous
Hmm.
because now, hey, look at what's happening. Now, here's my counter to that. And I said this all last year on these Fridays with the big job reports. We several times had a situation where the market has fallen because there was too many jobs created. But my thing is that this part of this, because of this pandemic, is a supply side shortage. We have a lot of demands for services. We went from spending money on goods to spending money on services once we
Hmm.
could get out of our house and do things. And so we need more people to come in to take these jobs. There's 8.8 million jobs open. And that's way off of the high of 11.4 million that it was at, but still significantly higher. Probably the average is around 4 or 5
Yeah.
million. I mean, it's really, really high. And so I see this over job growth as helping ease the supply constraints, which can maybe help inflation.
Hmm.
And the market's up today. So I think, and market was up last time we had one of these reports that was higher than expectation also. So I think there's some realization for what's happening there as far as that goes. But The bond market is struggling today because of this too. So that's going to be interesting to see how that plays out. But if we look long term or longer terms, this goes back to 1996. This is from the Bureau of Labor Statistics, and here's the number of jobs. Right, you can see it dips. Those big gray bars. The first gray bar there's 2000. Recession. Jobs dip, fine. 2008, they dip. Of course, the pandemic, which is a small, we had a 2-month recession, in the pandemic. 15 million jobs were lost, mainly because people closed down, because we couldn't be open, restaurants, all these things. But if you look at that trend since then, we're above where we were pretty significantly before the pandemic started. And so, this is going to be one of my themes actually for the first part of this year, is just trying to point out that the economy is not doing poorly. And I'll show all kinds of different things that are happening out there in that realm. And the stock market is a leading indicator. And again, if everybody's so worried about 2024, the stock market would probably already be coming down. It's a 3 to 18 month leading scenario. Now, sometimes the market can get surprised, right? Outside events, geopolitical events, what happens with China and Taiwan, what happens in Ukraine. There's things that are happening that could, surprise the market, because it's not a perfect predictor. But generally speaking, if you watch the market and it's going up, you can probably expect the economy to doing fairly well in the future. On an average basis, you would be best betting in that direction. As far as that goes. So I don't know. I think this is a really fascinating time frame to watch what happens. Are we creating a double top? Do we get into a new high? Those types of things. These are the things that we'll be watching for right now. And so I think things are doing quite well right now. I'm optimistic about what's coming up here. But again, we don't operate our business and our investment models based on projection basis. We watch what's happening and we kind of react to those, because right now you could make projections of all varieties.
Yeah, you could say the economy's going to blow up.
Yep.
Or go, through the roof.
If you listen to Wall Street's projections last year, you missed out on a 24% stock market run, right? And so again, watch what happens, look at the primary trend, stay invested if the primary trend is still up, maybe get a little bit more conservative if the primary trend starts to deteriorate, but stay in there until it turns into the primary trend is down, right? And that's the process. I didn't make that up. That's actually something that Charles Dow came up with in the 1880s, and it still works. I think it's a good sign and something to watch for as far as that goes. So anyway, that's what's happening this week. Really appreciate everybody kind of listening, to our summary. Look forward to being able to kind of do this again next week.